As we step into 2025, the bond market presents a dynamic landscape shaped by fluctuating interest rates and evolving economic conditions. Investors are witnessing a unique moment where traditional strategies may need a fresh perspective. With interest rates experiencing volatility, understanding the nuances of bond investing has never been more crucial. Whether you're a cautious investor seeking stability or an adventurous one looking for opportunities, navigating this market requires insight and strategy. The current bond market is influenced by various factors, including inflation trends, central bank policies, and global economic shifts. These elements create both challenges and opportunities for investors. For those who prioritize safety, bonds can offer a reliable income stream and a hedge against market downturns. Conversely, adventurous investors might explore high-yield bonds or emerging market debt, which can provide higher returns but come with increased risk. Understanding bonds is essential for making informed decisions in this complex environment. As we delve deeper into the world of bond investing, we'll explore different types of bonds, their roles in a diversified portfolio, and strategies to optimize returns. This journey will equip you with the knowledge to navigate the bond market confidently, regardless of your investment style. Join us as we uncover the potential of bond investing in 2025 and beyond, ensuring you're well prepared to seize the opportunities that lie ahead. To embark on your bond investing journey, it's essential to grasp some key terms. Bonds are essentially loans made by investors to borrowers, typically governments or corporations. When you purchase a bond, you're lending money in exchange for periodic interest payments and the return of the bond's face value at maturity. Interest rates play a crucial role in bond investing. They determine the cost of borrowing and influence bond prices. Yield, on the other hand, refers to the income generated from a bond, expressed as a percentage of its price. There are several types of bonds to consider. Government bonds, issued by national governments, are generally seen as low-risk investments. Municipal bonds are issued by local governments or municipalities, often offering tax advantages. Corporate bonds, issued by companies, tend to offer higher yields but come with increased risk, depending on the issuer's creditworthiness. Bonds play a vital role in a diversified investment portfolio. They provide stability and income, acting as a counterbalance to the volatility of stocks. By including bonds in your portfolio, you can reduce overall risk while still aiming for growth. Understanding these fundamentals will empower you to make informed decisions as you explore the bond market. As you continue your journey, keep these concepts in mind to build a solid foundation for your investment strategy. As we delve into bond investing in 2025, it's crucial to analyze the current market conditions that influence bond prices and yields. Economic uncertainty, driven by factors such as inflation, geopolitical tensions, and fluctuating consumer confidence, can significantly impact the bond market. When investors perceive increased risk in the economy, they often flock to safer assets like government bonds, driving their prices up and yields down. Conversely, in a stable economic environment, yields may rise as investors seek higher returns from riskier assets. Interest rate fluctuations are another critical factor affecting bond investments. When central banks adjust interest rates, it directly influences bond prices. Typically, when interest rates rise, existing bond prices fall, as new bonds are issued at higher rates, making older bonds less attractive. This inverse relationship is essential for investors to understand, as it can affect the timing of buying or selling bonds. Looking ahead to 2025, market trends indicate a cautious optimism. Analysts predict that while interest rates may stabilize, inflation concerns could persist, leading to a mixed environment for bond investors. Some sectors, such as municipal and corporate bonds, may offer attractive opportunities as companies and local governments seek to finance growth. Staying informed about these trends and forecasts will empower you to make strategic decisions in your bond investment journey. By understanding the interplay of economic factors, you can better navigate the complexities of the bond market in the coming year. As you navigate the bond market, it's essential to identify your investment goals and understand your risk tolerance. Start by assessing your financial objectives. Are you looking for steady income, capital preservation, or long-term growth? Your time horizon plays a crucial role in this assessment. If you plan to invest for the short term, you might prioritize stability and liquidity. Conversely, if you have a longer time frame, you may be more open to exploring higher yield options. Understanding your personal risk tolerance is equally important. This refers to your ability and willingness to endure fluctuations in your investment's value. Conservative investors typically prefer lower-risk bonds, such as government or high-quality municipal bonds, which offer stability and predictable returns. These investments are ideal for those who prioritize capital preservation and steady income over high returns. On the other hand, aggressive investors may seek higher yields through corporate bonds or high-yield junk bonds. While these options can offer greater potential returns, they also come with increased risk, including the possibility of default. For example, an investor with a high-risk tolerance might allocate a portion of their portfolio to emerging market bonds, which can be volatile but offer substantial rewards. By clearly defining your investment goals and understanding your risk tolerance, you can create a bond investment strategy that aligns with your financial aspirations. This clarity will guide your decisions and help you navigate the bond market with confidence. Once you've established your investment goals and risk tolerance, the next step is to research and select the right bonds for your portfolio. Start by exploring various types of bonds and their issuers. Government bonds, municipal bonds, and corporate bonds each have unique characteristics and risk profiles. Utilize financial news websites, bond market reports, and investment platforms to gather information about different bonds and their performance history. Understanding credit ratings is crucial in this process. Credit rating agencies, such as Moody's, S&P, and Fitch, evaluate the creditworthiness of bond issuers. A higher credit rating indicates lower risk, while lower ratings suggest higher risk and potentially higher yields. Pay close attention to these ratings when selecting bonds, as they can significantly impact your investment safety and return potential. Evaluating bond performance involves looking at several factors, including yield, maturity, and the issuer's financial health. Consider the yield to maturity, which reflects the total return you can expect if you hold the bond until it matures. Additionally, assess the bond's duration, as it measures sensitivity to interest rate changes. A bond with a longer duration may be more volatile in response to interest rate fluctuations. Finally, keep an eye on market trends and economic indicators that could affect bond performance. By conducting thorough research and considering these factors, you can make informed decisions that align with your investment strategy and enhance your bond portfolio's potential returns. Developing a solid bond investment strategy is essential for achieving your financial goals while managing risk. One of the key principles to consider is diversification. Just as with stocks, spreading your investments across various types of bonds can help mitigate risk. By including government, municipal, and corporate bonds in your portfolio, you can reduce the impact of any single bond's poor performance on your overall returns. Consider implementing a bond ladder strategy, which involves purchasing bonds with varying maturities. This approach allows you to take advantage of different interest rates while providing liquidity as bonds mature at staggered intervals. Alternatively, bond funds can be an excellent option for those who prefer a more hands-off approach. These funds pool money from multiple investors to purchase a diversified portfolio of bonds, offering instant diversification and professional management. Balancing risk and return is crucial in your bond portfolio. For example, if you're aiming for higher returns, you might allocate a portion of your investments to high-yield corporate bonds. However, to maintain stability, you could balance this with a significant allocation to safer government bonds. This mix allows you to pursue growth while cushioning your portfolio against potential losses. Ultimately, your bond investment strategy should reflect your financial objectives, risk tolerance, and market conditions. By diversifying your investments and considering strategies like bond ladders or funds, you can create a robust bond portfolio that aligns with your long-term goals. Once you've established your bond investment strategy, The next crucial step is to monitor and adjust your portfolio regularly. The bond market is dynamic, influenced by changing economic conditions, interest rates, and geopolitical events. Conducting regular portfolio reviews allows you to assess performance and ensure your investments align with your financial goals. As market conditions evolve, it's essential to respond proactively. For instance, if interest rates rise, existing bond prices typically fall. In such scenarios, you may want to consider selling bonds that are likely to lose value and reallocating funds into new bonds that offer higher yields. Conversely, if rates are expected to decline, holding on to existing bonds may be beneficial, as their value could increase. When deciding whether to buy or sell bonds, market analysis is key. Keep an eye on economic indicators, such as inflation rates and employment data, as these can signal shifts in interest rates. Additionally, pay attention to credit ratings and news related to bond issuers, as changes in their financial health can impact bond performance. Another tip is to consider your investment horizon. If you're nearing the maturity of a bond, it may be wise to sell it and reinvest in more favorable options. By staying informed and being willing to adjust your portfolio, you can optimize your bond investments and enhance your overall financial strategy. Regular monitoring ensures that your bond portfolio remains aligned with your evolving goals and market realities. As we wrap up our exploration of bond investing in 2025, it's essential to recap the key takeaways that can empower your investment journey. Understanding the bond market is crucial, especially in a landscape marked by fluctuating interest rates and economic uncertainty. By grasping the fundamentals of bonds, including types, credit ratings, and market conditions, you can make informed decisions that align with your financial goals. We've discussed the importance of assessing your investment objectives and risk tolerance, which serve as the foundation for your bond strategy. Diversification, whether through a mix of bond types or strategies like bond ladders and funds, can help mitigate risk while optimizing returns. Regularly monitoring and adjusting your portfolio ensures that you remain responsive to changing market dynamics, allowing you to seize opportunities as they arise. Now that you have these insights, we encourage you to apply them to your investment strategies. Whether you're a cautious investor seeking stability or an adventurous one looking for higher yields, the knowledge gained from this video can guide your decisions in the bond market. If you found this content valuable, please subscribe to our channel Passive Income Journey 777, like this video, and share it with others who may benefit from learning about bond investing. Stay tuned for more financial content that can help you navigate the complexities of investing and achieve your financial aspirations. Thank you for watching.